Let me paint you a picture. It's 11:30 at night. You're in bed, phone in hand, scrolling through Zillow like it's a horror movie you can't stop watching. 3 bedrooms, 1.5 baths, a kitchen that hasn't been updated since the Clinton administration, a backyard the size of a parking space, and right at the bottom of the listing, bolded, proud, completely unashamed, $588,000, listed as a charming starter home. You stare at it. You do the math in your head. You do it again, slower this time. Same answer. You close the app. You open it again. Still $588,000. That knot forming in your stomach, that quiet rage mixing with quiet panic, that's not anxiety. That's your brain telling you something is deeply, fundamentally broken, and it is absolutely not you. My name is James, and today we're going to do the math that nobody in the real estate industry wants you to see. Not the "you're approved" math, not the "homes always appreciate" math, the real math, the "can I actually live my life and own this house at the same time" math. Because those are two completely different conversations, and confusing them could cost you an entire decade of your financial life. So before we go any further, let me ask you something. What do you think the average American household actually earns? Because whatever number is in your head right now, hold on to it, because we're about to run it against a $588,000 house, and the result is going to bother you. The median household income in the United States right now sits at roughly $84,000 a year. That's according to the U.S. Census Bureau. And look, that is not a poor household. That is a working household. Two people grinding, paying bills, doing everything right, and trying to get ahead. Now, a $588,000 home is 7 times that annual income. 7. For decades, the bedrock rule of personal finance has been simple. Don't buy a home that costs more than 2.5 to 3 times your gross annual income. Under that rule, an $84,000 household should be shopping somewhere between $210,000 and $252,000, not $588,000, not even close. But here's where it gets brutal. In cities like Austin, Denver, Nashville, Miami, Phoenix, and virtually every suburb within 45 minutes of a major metro, $588,000 doesn't get you a dream home. It barely gets you eligible. It is the price of entry for a house that a previous generation would have called completely ordinary. So either everyone buying homes right now is secretly wealthy, or something has gone catastrophically wrong with the relationship between wages and home prices. Here's the answer. According to data from Harvard's Joint Center for Housing Studies, since 1990, home prices have climbed roughly 4 times faster than wages. 4 times. That gap isn't a crack in the system. It is a canyon. And most Americans are standing on the wrong side of it, wondering what they did wrong. They didn't do anything wrong. The math was broken before they even showed up. Now, here's where most people get completely blindsided, and I mean completely. They see the mortgage number, maybe $3,500 a month, and in their head, that's the number. That's what the house costs. Done. No, that is one piece of it. And if you stop there, you are setting yourself up for one of the most painful financial surprises of your adult life. Let me walk you through what it actually costs to own a $588,000 home. Because this math, right here, is the difference between a home that builds your life and one that quietly consumes it. You've scraped together a 10% down payment, $58,800. And by the way, the Federal Reserve reports the median American savings account holds around $8,000. So that down payment alone represents years of serious discipline for most households. But let's say you did it. You saved it. You have it. That leaves you with a loan of $529,200 at current interest rates sitting between 6.5% and 7%. Your principal and interest payment lands around $3,450 a month. Fine. We build from there. Now add property taxes. Conservatively, depending on your state and county, that's another $490 to $600 a month. On a home of this value, expect closer to $580. Add homeowners insurance, and this is rising fast in a lot of markets because of climate-related risk. Budget another $375 a month. Add PMI, private mortgage insurance. Because you put less than 20% down, the bank charges you a monthly fee to protect themselves in case you stop paying. Not you. Them. It is, without any exaggeration, a financial penalty for not already being wealthy. That's another $310 a month gone. And finally, maintenance. The industry standard is 1% of the home's value per year. On a $588,000 house, that's nearly $6,000 a year, or $490 every single month, sitting in reserve for when the water heater dies, the gutters fail, or the HVAC unit quits on the hottest day in August. Add it all together. Here's your complete monthly number. Mortgage, $3,450. Property taxes, $580. Insurance, $375. PMI, $310. Maintenance reserve, $490. Total, $5,205 every single month, before HOA fees, before the pipe that bursts on Thanksgiving weekend, before the roof assessment nobody saw coming. $5,205 is the floor, and most buyers never see this number before they sign. So let's reverse engineer this into the income you actually need. Financial planners universally recommend keeping total housing costs below 28% of your gross monthly income. Banks will approve you at up to 43% debt to income. But approval and affordability are not the same number. And that distinction, it could define the next 30 years of your life. At 28% to support $5,205 a month in housing costs, you need a gross household income of $223,000 a year. Even if you stretch it to a more aggressive 35%, which most honest advisors would already call risky, you still need $178,000 annually. And here is what that actually means. Only about 8 to 12% of American households earn $178,000 or more, which means by any honest financial standard, a $588,000 home is structurally beyond comfortable reach for nearly 90% of the American households being actively marketed to by this exact market. Not a stretch, not a tight month, beyond reach. Now, I know exactly what some of you are thinking. But James, what about two-income households? What if two people are both working? Doesn't that change everything? Fair. Let's run that scenario exactly. Meet the Hendersons, two working professionals, combined household income of $155,000 a year, solidly above the national average. These two are doing well. Upper middle class by every standard. They should be fine, right? After federal and state taxes, FICA, and a modest 401k contribution, they take home roughly $9,200 a month. That is their real money, the number that actually hits the bank account. Subtract $5,205 in monthly housing costs. They have $3,995 left for everything else in their entire life. 2 car payments, $850. Auto insurance on both vehicles, $240. Gas, because nothing is walkable in the suburbs they could actually afford, $280. Student loans, because those degrees are exactly what qualified them for the jobs that qualified them for this mortgage, $580. Health insurance premiums, $390. Groceries for a household trying to eat reasonably, $750. Utilities, internet, and 2 cell phones, $420. That is $3,510 in essential non-housing expenses. Subtract that from the $3,995 remaining. The Hendersons have $485 left per month. No childcare, no kids' activities, no clothing budget, no medical co-pays, no car repairs, no emergency fund contributions, no extra retirement savings, no dinners out, no vacation, no margin, zero cushion of any kind. One unexpected expense, a $1,500 car repair, a $900 medical bill, a $2,000 HVAC fix, and this family is reaching for a credit card or missing a payment. These are not reckless people. They are two professionals doing exactly what society told them to do, and they are one bad month away from genuine financial crisis. Here's the number that should stop you cold. This household is spending 56% of their take-home pay on housing, more than half of every dollar they earn, going toward one asset. And we have a name for this. We call it house poor, like it's quirky, like it's just a funny grown-up thing that happens. We've built an entire cultural mythology around barely surviving your mortgage. You're building equity. You're investing in your future. You're being an adult. No. You're drowning in slow motion and calling it swimming. And here's what nobody talks about. What this actually feels like from the inside of that life. It feels like hesitating at the gas pump, doing the math before you hit full. It feels like mentally splitting every grocery run. Does this come from the food budget or the house budget? It feels like a low-grade financial dread that never fully powers down. Not on weekends, not on holidays, not during the moments that are supposed to feel like rest. It feels like being successful on paper and suffocated in practice. The stress of an unaffordable home doesn't stay neatly in the housing column of your budget. It bleeds into your relationships, your health decisions, your willingness to take career risks, because losing even 2 weeks of income is simply not an option. You become anchored to a job you may hate because the house demands it. At some point, the house doesn't belong to you. You belong to the house. And somehow, we've normalized this, dressed it up as ambition, called it a milestone. So, what do you actually do? First, stop letting the bank's approval letter define your affordability. A lender's job is to originate profitable loans, not to protect your quality of life. Being approved for $588,000 tells you exactly nothing about whether you can afford $588,000. Their risk ends if you default. Your risk compounds for the next 3 decades. Second, before you fall in love with any listing, calculate the complete monthly number: mortgage, taxes, insurance, PMI, if applicable, and maintenance reserves. That is your real housing cost. If it exceeds 28% to 30% of your gross income, the math is structurally working against you, and a beautiful kitchen does not change the math. Third, renting is not failure. Let me say that more clearly. Renting, while you build savings, grow your income, and wait for the right conditions, is one of the most disciplined financial moves available to you right now. The throwing money away on rent narrative completely ignores the thousands of dollars per month in interest, taxes, insurance, and maintenance you'd be throwing at a house you can't sustainably afford. Rent has a cost. So does a bad mortgage. Know which one costs more in your specific situation, and be honest about it. Fourth, expand what options means to you. A smaller home in the same market, a city with a more realistic price-to-income ratio, a longer savings runway that gets you to 20% down, which on a $588,000 purchase eliminates PMI entirely and saves you over $300 every single month for years. These aren't concessions. They are strategies. And in a broken market, strategy is the only edge you actually have. Here's the clear, honest bottom line. A $588,000 home in 2026 requires a household income of $178,000 to $223,000 to own without constant financial strain. If your household income is below that range, the numbers are structurally working against you, and no amount of positive thinking, hustle income, or color-coded budget spreadsheets changes the math. You are not failing because this feels impossible. You are correctly reading a market that has priced out the vast majority of American households. The market is broken. The pricing is broken. And the most powerful thing you can do right now is refuse to pretend otherwise just because a bank handed you an approval letter. Buy when the math works, not when the emotions do. That is not pessimism. That is not giving up. That is the most important financial boundary you will ever draw for yourself. If this video shifted how you see housing costs, do me a favor and share it with someone who's about to make one of the biggest financial decisions of their life before ever running these numbers. Drop your city in the comments. I want to see how this math plays out in real markets all across the country. And the next video is already waiting for you. What a genuinely affordable home purchase actually looks like in 2026, and how to build toward it without wrecking your financial life in the process. Don't buy the house, buy the math first. I'll see you on the next one.